Okay, welcome everybody. Before we get going, I just want to do a quick disclaimer here, just a standard disclaimer, right? Not financial advice. Neither myself nor my guests are your financial advisors. This is for entertainment purposes only. For full disclaimer, please check YouTube notes below. With that out of the way, though, I have a special guest here today, Peter Boockvar. Peter is the Chief Investment Officer. Peter is the Chief Investment Officer of Bleakley Financial Group, an $8 billion wealth management firm. Prior to Bleakley, Peter spent multiple decades working within various funds and firms and possesses a lifetime of relevant experience and expertise. He is a regular contributor to CNBC and other news outlets, and is the editor and founder of the Book Report. Peter, it's nice to meet you here today, and thank you for your time, and thank you for coming onto the show.
Thanks, Matt, for having me.
Perfect. Well, we'll just dive right into it here, right? I want to kind of pick your brain, a little bit of things from soup to nuts here, I suppose. I want to talk about what Bleakley offers and what precisely Bleakley is, and maybe the philosophy behind what your investments there, but maybe also your attitude and approach to commodities in today's market. And then also maybe just, I think what I want to focus on ultimately is maybe some advice that you might offer to my listeners and to the retail sector in general. But maybe just to start out, right, just nowhere else to start but the beginning, why don't you actually, discuss Bleakley and yourself a bit, I suppose, right? A brief history, both of yourself and how you came to be at Bleakley today.
Bleakley is a wealth management firm. We have about 60 different financial advisors, and managing about $9 billion now, and mostly for individuals of all income levels and other institutions. And as the CIO, I manage two particular strategies: one a global macro strategy, and another one an income-focused strategy. And just trying to help clients with their financial lives and maneuvering through the investing landscape. Prior to coming here, I was the chief market analyst with the Lindsay Group, which is still run by Larry Lindsay, former Federal Reserve governor and White House economic advisor. And prior to that, I've been mostly on the sell side, but also on the buy side at hedge fund and managing money throughout. And brings me to where I am today in this business for about 30 years.
Perfect. Well, yeah, thank you. And again, appreciate your time for taking it to be with me here today. So why don't you, maybe a question I have, and this is going to be fairly general, right? But I'm sure you have different portfolios and strategies, but could you maybe discuss what is maybe an overarching philosophy or strategy that you operate by through your work with Bleakley?
Well, there's not necessarily, there are multiple strategies, but the one, at least for my two portfolios, is, and it's just my own personal style of investing, but we marry that with other styles as well. But mine is through a value lens when looking at the markets. But when it comes to total construction of a client portfolio, we definitely have growthy parts of the portfolio and value parts of the portfolio, and my strategies sort of fit the value part, but also I add a multi-asset and global macro strategy in the sense of I'm very geographically agnostic when it comes to finding investment ideas. And whether it's a stock, a bond, or a currency or a commodity, to me, where there's opportunity, I can go there.
Well, if you don't mind, maybe I'll just follow that garden path for a moment here. You discuss agnostically geographic. Could you discuss obviously there are risks associated with not with adventuring outside of tier 1 jurisdictions, shall we call them? Are you true agnostic? Are there things that you concern yourself with, or how do you protect yourself against the risks that come requisite with geographical risk?
Well, I'm not investing. Luckily, I wasn't investing in Russia. Or not investing in, I guess, frontier emerging markets, you can call it. So when looking overseas, it's Europe, it's countries in Asia, or even Latin America. So while there are developing, quote unquote, third world countries there, I'm not really necessarily going below that. Now, of course, there are political challenges that you need to deal with, and even if you're investing in Asia, you have to see how the geopolitical relationship plays out between the U.S. and China and the rest of the world, depending on how they manage Taiwan. So there's always political risks that you need to focus on, but there are even political risks in the U.S. When you have two different parties looking at the world in two different ways and how they want to manage policy.
Hmm. I think it's a fair statement. I think that obviously sometimes it's a matter of a devil you know for a lot of people that they prefer the known risks of a North American jurisdictional as a Canadian, as I meant include myself there, right? That the known struggles with permitting, shall we say, from a commodity perspective versus the unknowns, as you say, of the frontier world, right? So I guess I have maybe two questions here, maybe trying to keep it angled towards this kind of microcap resource discussion that I'm coming from. Maybe first of all, could you just discuss? I mean, so again, I understand that you have multiple portfolios, so it's difficult to say there's one size fits all. But when we talked briefly on the phone prior to this, you mentioned you are long commodities, and we'll get into that. But I mean, in terms of portfolio composition, can you discuss what ratio or percentage commodities or exposure to commodities work for you in terms of Bleakley?
Well, it depends on the opportunity set. There are going to be times when I own no commodities. The one thing about that sector is it's obviously very uh, sort of streaky in the sense of
Mm-hmm.
being highly cyclical, and it has its bull markets and it has its pronounced bear markets. And bull markets last a while, bear markets last a while. You can go through basically the desert owning commodities in bear markets that you never think you're going to ever sip a glass of water again. So when it's time to be in commodities, it's also a balance too, because you don't want to be too overweight, just because again the cyclicality of that sector. I don't think there's necessarily one sort of rule of thumb when it comes to exposure. I guess you can use maybe a benchmark of commodity or commodity stock exposure within the S&P. You take energy, for example, and use that as a weight. But
Mm-hmm.
uh, I just feel like the way that we do it is something that clients are comfortable with without having some sort of an exact science behind what the right ratio should be.
Mm-hmm. Oh, fair point. And if I ask that because a strong I long for a world where there's a more educated retail investor in this sector, right? I mean, as you said, it's a very dangerous, a very volatile sector, and you have to be nimble, right? And so I think that kind of when you invest in the sector, eyes wide open, knowing what you're getting yourself into, goes a long way towards protecting yourself from any of those volatile downsides. Um, I do have
And
here's
also, we talk homogeneously about commodities, but all of them have their own different characteristics that you have to be really aware of. And parts of the commodity industry are really tough. And the metals and mining, for example, is a really crappy business. Uh, I mean, I don't know if there's any industry that's destroyed more capital than the metals and mining sector. So you got to be really, really careful, really patient, and just be eyes wide open with respect to the risks.
hmm And I should be careful too. I mean, when I say commodities, I will not be able to discuss cotton with you in a meaningful fashion or corn or something, right? I definitely come at this from a metals and resources mineral sector for sure. I can't help but ask you this. This is a classic kind of when you troll the retail boards. This is a classic question around when you get funds like Bleakley, right? And knowing that maybe you are philosophically aligned with commodities in this stage or this wave stage in the stage in the market. There's always discussions around minimums, right? When a company's too small or too illiquid for larger funds to pay attention to. And so I guess I'll just take the opportunity to ask you right now. I mean, are there minimums that you wait for as a portfolio as a fund manager to that companies have to achieve before you invest in it? I'm talking market cap or liquidity minimums for you to be able to take a meaningful position.
There's no particular sort of threshold, but because again, the difficulty of this industry for our clients, they're not as uh, roll in the dice type behavior. So we're more focused on the bigger companies. Now there'll be some juniors that we'll look at, but when it gets into the very early stage uh, part of the life cycle, I guess you can say, before even development gets started, we shy away from those. It's if I'm going to buy them, it'll be for my personal account and nothing more.
Mm-hmm. And I think that a lot of times you talk about the value destruction. That's a very, very, very cogent point. I think a lot of times you see retail greed starts to overrule them, and they that asymmetrical to the downside of the risk reward ratio, right? That they chase these returns too much. And again, part of what I hope to be developing as my own thesis for my followers is that you can have uh, uh, powerful upside, exceeding index potential without having to chase those very dangerous kind of the fringes of it in terms of pre-discovery plays, right? But maybe I'll just transition here. Why don't you just discuss your approach to commodities? Right, you make a very fair point that it's very market dependent, very dependent on where we are in a macro sense. Could you maybe just discuss? You are long commodities. You say it with the qualifications. Of course, I think that you kind of have to. But which ones are you long in particular, and maybe why? Do you want to discuss your bull case for a few?
We have we have a decent sized position in precious metals, but a lot of that is more the physical gold and silver, particularly. Well, we don't own any direct palladium or platinum, and miners, both through a diversified fashion within ETFs, but some individual names. The other area we like is uranium, and we play that through Cameco and a broad basket of uranium stocks, in addition to some of the physical holdings. And then also energy is our other decent sized position when it comes to commodities. And we play it within commodity stocks, both oil and natural gas, but also some of the natural gas pipeline companies that to me are pretty attractive as well. Now, with respect to like agriculture, for example, and we've been in and out. I had been long fertilizer stocks for years,
Mhm.
and luckily sold them right after the Russian invasion of Ukraine last February, March, when they spiked up. The
Mhm.
interesting thing about ag, particularly the row crops like corn, soybeans, wheat, the demand for those is pretty linear. As the world gains population, as the rising middle class that we see in many countries, there is a pretty consistent rise in the demand. So when it comes to investing in ag, you got to focus a lot just on the supply side. And what differentiates ag from other areas is, well, at least in North America, there's essentially one planting season and one harvest. So a poor yield one year can be immediately rectified the following year. In South America, uh, you have more because of the weather, of course. But so that is a bit more difficult is trying to figure out the supply side. Whereas energy and industrial metals, precious metals, the supply side is a much longer time frame in terms of developing a project, so that there's more visibility on that. On the other hand, it gets trickier in trying to figure out the demand side for industrial metals, a little less so with respect to oil, because there are inelasticities when it comes to the demand for energy, as long as
Mhm.
people want to drive or turn the lights on, or need to make something with a petrochemical plant, for example. So you have to weigh all these things, but you have to understand that a lot of these investments are more rent investments rather than long-term closed your eyes investments. Buying an oil stock or buying a miner is not like buying Procter and Gamble, where you can just close your
Mhm.
eyes and hold it for a long time. But as long as you understand that, then I think that you can better maneuver through it. And you want to sell commodities when it makes it on the front page of the newspapers and everyone loves it, and when everyone hates it, that's the time to look at it.
Mhm. I think that's a point well made, right? And understanding eyes wide open, the cyclicality of this, and yeah, it is not a. I mean, it's a somewhat flippantly, I'll say that commodities are kind of like a long term call on humanity, kind of as you referenced yourself, right? But at the same time, yeah, no, these are not. You can't hold them for decades and expect to have meaningful returns. It's not that kind of sector. And again, discussing potential reasons why sometimes retail investors lose their shirts is they do just kind of close their eyes and pretend like they can just call this like even if the company doesn't go bankrupt, even if they have a great project, it's so easy for them to be just diluted into oblivion, right? So why don't I just I want to ask you then. I think you're already kind of touching on this, which I appreciate, but you know. Can you discuss maybe some of your selection criteria or the data you rely on when you make these decisions about when you go long and when you go short, or when you decide to leave the sector?
Well, it's in making that decision, it's part of my just entire sort of macro framework and trying to have a finger on the pulse of what's the state of the global economy. And I say global because these commodities are globally driven. You can't just look at one country's economy and say that that's going to determine where the price of oil goes, for example. Now, of course, you could have said that with China, with them being a very large, dominant demand driver when it comes to certain commodities. But generally speaking, you just want to have a sense of where we are in the economic cycle. Again, each of these sort of commodity groups have their own dynamics, and it's just important to know from the basic supply and demand picture, but also how the global economy sort of works its way through that. Again, because the state of the economy will a lot of it affect the demand side, but also understanding how things affect the demand side. I'm sorry, the supply side. But you take energy, for example. Well, you also now have to tie in the higher cost of capital and how that is affecting investment decisions, both on just drilling or just holding physical, for example, barrels of oil and having to finance it now at a higher cost, and how that sort of works its way through. Um, so it's a variety of factors that you really have to focus on. But it's not easy. It's one of the things of again, commodity investing is you have to have a lot of patience, because there could be times when you're eventually right, but it can take a lot longer for your thesis to play out. I mean, let's take precious metals, for example. Now, like take gold. I mean, gold rallied, I think it was 12 years in a row. But interestingly enough, the rally sort of ended just as the world entered negative interest rates. Now, if you'd think that negative interest rates would prolong the bull market in gold, you'd think it would be the ultimate backdrop for gold. But negative interest rates really started in 2011, just when gold actually topped out after its run from 1999 2000. So it's not everything always makes sense when you think about it. Now, gold's back to where it was at the peak of 2011, but you could have argued that when there was $18 trillion of negative yielding bonds, that would have been the ultimate backdrop, but it wasn't. Gold traded contra to what you would think. So it's not easy being in this business.
Well, I might ask you why, and of course, this is how many angels dance in the head of a pin sort of question. But I think that this is a good question. I might just jump ahead here. That a lot of people look back to the 70s when gold had a huge spike up, stagflation, inflation, interest rates. I mean, now we have quantitative easing, as you say, as you kind of reference, and people were, you would expect, as you yourself referenced there, that this would be a very strong time for gold, where there would be another re-rating like we saw in the 70s, early 2000s. And, gold has been consistently flirting with its all-time highs, bouncing off and coming back a bit, but maybe not necessarily that re-rating that people were, if you were a pundit or a talking head, that, you would have pointed to and said, these are the conditions. Obviously, I know this is a difficult question or difficult, challenging answer, but is it just a matter of just, like you say, just timing not quite being right yet? Just give it time, or are there conditions or factors maybe that that maybe the generalist investor is missing this to explain why gold hasn't responded as a safe haven as maybe you would expect?
Well, there's certainly a few big factors, at least over the last couple of years, that on one hand sort of has stunted the potential upside, but on the other hand, you can argue, wow, gold trades really well in this kind of environment. I mean, we've had on one hand the highest rate of inflation in 40 years, and you'd say, okay, well, that's a debasement, a form of debasement of one's currency. Gold should do well in that environment. But then on the other hand, you've had the most aggressive monetary tightening in 40 years in response to that in turn has been a headwind. Now, gold was actually unchanged in 2022 in the face of rather sharp rise in interest rates. You can say, wow, it traded like a champ, and certainly in dollar terms. I think now the question with gold is where is its place in the world? And with still very high, at least in the US debts and deficits, you can argue that it has an important place. When you look at the confiscation of Russian central bank and government assets, you can argue as a reserve placeholder, gold has its place. And considering how, in a way, chaotic the world looks, both from a geopolitical standpoint, even and also monetary and fiscal standpoint, gold certainly has its place, and that's why I believe with everything that has sort of been thrown at it the last couple of years, it's only in dollar terms, $100 ish, $150 ish from an all-time record high. And I
Mhm.
always make the joke that since it's been around for 5,000 years, it's trading near a 5,000-year high.
No, it's a point well made, and I guess I can't help but be somewhat colored by the kind of the limp response that you see from not just the commodity, but the actual producer, developer, explorer sector, where you have this, yeah, gold trading at all time high, but you have these companies, strong companies, good companies, not a company of charlatan or used car salesman sort of thing, but that are trading at multi-year lows or approaching those, right? And there's a disconnect here that I think a lot of people are frustrated by, and I think it goes back to what you said is that well, I mean, the market can remain irrational far longer than I can remain solvent is part of the concern here, right? Maybe I'll ask you though. So I may transition back here. You discuss, being long on individual commodities, and unsurprisingly, you discuss how microcap explorers not exactly your cup of tea in terms of through the eyes of Bleakley, but maybe can you discuss? I mean, royalties, producers, developers. I mean, can you maybe break down the importance or value that you place on each of them, and then I'll pause there and then I'll let that sit for now.
Well, royalty company is certainly a much better business.
Mm-hmm.
The thing about the mining business is uh, unless you're in a good jurisdiction like the US or Canada or Australia, for example, uh, you got to deal with the politics of your business and the government who can wake up one morning and say, we're going to take more of our share.
Mm-hmm.
Then you actually have to um, get the stuff out of the ground, which is never easy, properly budgeting for that. And then you're selling it at a price that you have no control over. So the mining business is, like I said earlier, just pretty crappy business. Uh, that said, there are uh, better businesses within that, with royalties certainly being that case, but they're always, valued as such with more with higher multiples than other things. Uh, but just you go in, using the term again, eyes wide open with this to the mining business, knowing that it's a tough business, but trying to sort of catch a cycle. Right now, I think we have the potential of catching a cycle because at least on the mining side, the companies that are, instead of prospecting, are actually digging this stuff out and selling it into the marketplace. Margins are pretty good right now. You can sell gold for $1,900 plus an ounce, and your all-in sustainable costs are low 1,000s. That's a
Mm-hmm.
pretty hefty uh, margin for error. And so I think it's pretty good time to be in this business right now, and hopefully it will stay that way. I mean, I do think a lot of companies in existence today have certainly learned some big lessons from the destruction of capital that we've seen over the past 10, 20 years, and they're less inclined to repeat those mistakes. And the same is said in energy, where there was a lot of um, destruction of capital in the U.S. shale industry, for example, where investors were rewarded for drilling, 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 regardless of how much cash was being burned
Mm-hmm.
in order to do so. And now it's just the exact opposite: is we want to see cash flows first rather than drilling for drilling's sake. And so I think that that's an important benefit to shareholders that many companies have taken heed to, that tells me that there's still upside left in this commodity bull market from owning the miners in particular, and still supply demand imbalances that could help the actual prices of these commodities to go higher from here.
I like that you make that point. Just I was having a conversation with a CEO of a developer, and he was making the point quite convincingly that not all development is equal, right? That you have developers who, like you say, drilling for drilling's sake, get that headline grabbing assay, raising funds for the sake of just continuing to drill. And then but on the flip side of that, you have the development where it is that painstaking, arduous, call it boring from the perspective of an impatient investor, but actual in the business of building an actual mine, not just headline assay numbers, right? I think that's a point well made. I think that's another potential area for retail investors to maybe get to be self-reflective of, is that what they want is not always necessarily in the best interest of what it takes to make a mine, right? Maybe
Yep.
I'll ask. I'm going to ask you as a representative of Bleakley about this, and then maybe we'll switch gears after that, and maybe ask you, just as a private investor discussing if that makes sense, right? But because I think obviously your strategies and goals, managing $9 billion is going to be different than mom and pop John Q. Public sort of thing, right? So maybe I'll ask you, returning to this concept of you said you liked royalties. Could you just name drop, Franco Nevada or Wheaton? Could you name drop a couple of companies that you are looking at closely or long on, or you think are good picks right now from Bleakley's perspective?
Yeah, I mean the ones you mentioned, we're long through some of the ETFs that we own, so we don't, so we're long them. But again, it's part of an ETF. There are some individual names like Agnico we own, and sort of the one, call it, it's not pulling copper and gold out of the ground yet, but Seabridge is one of the ones we really like as one of the largest undeveloped projects in the world that seems to be it's not going to develop the mine in terms of getting it out of the ground, but they're developing a lot of the infrastructure on their own, and then hopefully soon be bringing in partners to further exploit it. But to me, that is, I never want to say less risky. You never want to say that, but it seems like they're well along the path prior to actually developing, and that there's quite a find that they have in actually multiple places.
Well, I think you make a good point there that they're known bad pun, they're known commodities, right? This is why I prefer developers to explorers in many ways, is that explorers, there's not really a heck of a lot of data to drive your analysis, and it becomes, you're veering into gambling quite often, right? Versus developers where, if you get a PEA or PFS, right, and you have a data-driven analysis, you can sit and kind of plant your flag on in terms of understanding what this is, and actually make apples to apples comparisons with other developers. And so it's, like you say, not necessarily that there's reduced risk, but maybe so much that the risks are known versus these earlier riskier projects where you don't even know, good or bad, what's about to happen, in terms of the drill turning or what have you, right?
Right.
So why don't we switch over here? So kind of a fresh little mini category, I suppose. Again, a thing that I've mentioned a couple of times is my part of my goal is that I would like to see a more informed, intelligent retail investing community, right? no one likes to see anybody lose money. Everybody wants to, I hope, everybody wants to get rich, and I don't benefit from other people going broke from making bad decisions. I think that the industry, talking about mineral commodity sector in general, benefits from reasoned, informed investors, right? And so, I guess maybe the question I'll ask you, what is something, consider if you could offer advice in an informal sense, right? What would you say to retail investors in terms of what do you think the retail investor typically struggles with that you think restricts their ability to succeed?
It's a great question. I think at times it can be the temperament that is needed for successful investing over a long period of time. Understanding that when you buy a stock, you're actually investing, you're owning a piece of that business. And people can have moments where they're a great trader and they're just basically trading stock symbols, but it's understanding that you're owning a piece of that business, and not all businesses always do great. And there's never just this linear path to success. There are bumps in the road. Now, some companies have greater sort of track records in terms of that success, but not all do. But even those that have bumpier roads, that doesn't mean that they're not going to get to an eventual level of success. So it's trying to just understand the fundamentals of a business, because again, that's what you're buying when you're buying a stock, you're investing in a business, and not sort of getting caught up in the daily fluctuations and the daily noise. If you're not going to buy and sell your house, if there was sort of a stock ticker in your bedroom and the value of your home would go up or down, you don't pay attention to it. Now, technically speaking, the value of your house is changing every day, just as the value of a stock is changing every day, particularly in real estate, for example. So it's also not buying something just because it's up, not selling something just because it's down, because that's just crowd following. So I think that investors need to, it's important to do your own work, understanding the investments that you're making, because I think that helps in sort of blocking out a lot of the noise and again, getting caught up in market psychology where, emotions run many times in one direction and they run a lot of times in the other direction. And the one thing in the stock market is human nature never changes. People get more excited about things the higher they go. Sentiment follows price. And over time, and sometimes it's important to buck that trend if you're going to be successful over a long period of time.
I think that's a very well made point, right? The need to be dispassionate, right? And emotions cost you money. If I wanted to feel emotions, I'll take my wife for a long walk on the beach, right? Not take it to the markets with me for that day, right? Maybe more specifically, if you don't mind, what would you look for in companies, right? So commodities or companies themselves. What are some benchmarks or metrics that you would maybe suggest investors take a look at to help make their decisions?
I like to own companies where management has financial stake of substance, where they actually own stock. They put their money where their mouth is, that they have a long track record of success, of transparency, of honesty in running their business. Now, it's not like I'm having conversations with them all the time to necessarily gauge this. A lot of times it's the performance that reflects that, but I think ownership of stock is important for me to see because if the CEO is not going to own much stock in a company that he or she is running, well, why should I be buying that stock?
Mm-hmm. And there's lots of ways for insiders to make money that are not privy to retail investors, and I think that's point well made. So on the flip side of that, then, what is something that you would maybe suggest to avoid or be distrustful or wary of as a potential red flag when individuals are researching these companies?
Well, from a big picture standpoint, a lot of it is where are you doing business? What jurisdictions are you doing business? I consider myself a relatively conservative person that I don't feel the need I need to roll the dice. And I don't need, I do just I sleep better at night knowing that companies that we're involved in are mining in more secure, in terms of the rule of law jurisdictions. And I don't want to wake up one day and a company we own has their mine confiscated. It's just let somebody else take that risk. I'm just not in the mood for that.
Hmm. Mm-hmm, mm-hmm. So, kind of rapid fire questions here. But we discussed we are in a what is a bear market for commodity companies, right? Uh, and I mean, everyone dreams for the day of a few years back when the bulls returned and generalists returned to the sector. Is there something that you might discuss? I mean, what is there a trigger that you might be waiting for that you think would see people return? That big wave that everybody waits for, as you talked about, it's this boom bust cyclicality of commodity and commodity companies. What is that trigger that might that next wave up, I guess, right? What would you expect might be a potential trigger for that to see
A,
generals return?
a very easy answer. It's higher prices.
Yeah, okay, yeah.
That's it. When gold breaks above 2000, goes to 2500, you can be sure a lot more people are going to like it at 2500 than at 1900.
Hmm.
I mean, that's just the nature of human nature is sentiment follows price, and that's with everything.
Yeah, those emotions, right? And once the emotions take control, so I guess I can't help but begs the question. So, what are potential triggers for we'll talk gold particularly, right? I mean, what do you see triggering gold to finally take that next leg up and reestablish new higher highs?
I think it starts with the Fed ending their interest rate increases. They're pretty set on raising it in July, uh, the end of the month, uh, but that could be it. And I think that's why gold still pretty much hangs in there, because I think the market is sniffing out that it could be it. Now, could they raise again after that? Yes, but in the context of already hiking north of 500 basis points, we're coming down to the end. And if the economy weakens thereafter, not that they're going to be slashing and burning interest rates, but I do think when they start cutting rates, maybe at the end of the year into early next year, that's going to be a positive boost. I'm looking towards the U.S. dollar. The U.S. dollar really can't get out of its own way. And I think a lot of that coincides with the Fed ending their hikes, but also, there's the rising U.S. debts and deficits is now getting a lot more attention, and both relative to GDP from a total debt level, but also the budget deficit as a percent of GDP, which is north of 7% even before a recession started, is a pretty alarming number. Where for decades deficits didn't matter, but maybe now they do, and that could be potentially a headwind for the dollar, which would benefit precious metals.
That's what I find interesting too, right? You talk about a ballooning debt in the last 10, 20 years, and it's so funny because again, you have this expectation that it will have this response to gold or to precious metals, and I think you just said it right. It doesn't matter until it does, right? And it could be a long time before that rubber band snaps back, but eventually, I think as you referenced, that there will come a time where it will matter. And I think a lot of people's in this sector, their investment thesis is built around things like that, and people have lost their shirts being too stubborn and obstinate and not getting out of their own way. But eventually, I think that the piper has to get paid, right? Eventually. I'm circling to the end here. Just maybe one more question here, and this is one that we haven't really touched on as much as I thought maybe we might. But I mean, as someone who I operate, predominantly in the commodity sector, and a lot of people in this sector, CEOs and analysts, right, keep trying to hammer home the point to generalists and to the public at large that there is, and we kind of referenced this previously, that like chronic and structural supply and exploration shortages that are just starting, and in terms of the runway it takes to create new projects, just not enough turnaround to steer this boat away from the iceberg, so to speak, right? Uh, and yet we still see not a lot of interest in the sector, right? And so I guess you can probably guess where I'm going with this. But I mean, the market is typically forward-looking, right? Bedevilingly so sometimes. But here we are with the sector where the valuations are still rock bottom, and these companies are still struggling to get off the mat. Do you want to discuss? I mean, why is that such a case, right? You have a forward-looking market, you have looming chronic and difficult to solve supply and exploration deficits that are not going to be solved quickly, and yet we still have very depressed valuations and pricings. Is that something you want to touch on?
Well, markets are forward-looking sometimes, and sometimes they're not. What was the market looking at in January 2022 when it was the S&P 500 was at 4,800? What was the market looking at in October 2007 when the S&P 500 was at a record high? So sometimes it is, sometimes it's not. I find that over the last bunch of years, it's become much, much less of a discounting mechanism, and the market really just focuses on what's right in front of its face. And if you're a company, did you meet or beat earnings expectations? And if you missed, you're in the doghouse. The thing about owning mining companies, it's been just perpetual disappointment. So there's no chance that owning a mining stock or the miners are going to somehow discount what they see in the future. No, it's only going to respond to where the prices go in terms of the metal. It's not going to sort of price out or discount anything again, because it's been so many years of people getting burned that it's only going to be what's in front of your face that at least today the market's going to price in.
Fair, and that's it kind of draws back to it's this paradox where you reference being contrarian, have encouraged your convictions to turn left when everyone is turning right in terms of those emotional trade-offs, right? But then there's a paradox that's being early can sometimes be the same thing as being wrong, right? That it takes so long, and if you talk about value destruction, that even though you're right, maybe you end up you're losing your shirt regardless, right? And I think
Yep, for
this,
sure.
yeah, it ties back to what maybe your theme so far has been, is this idea that you have to be nimble, you can't get married to a stock, and you have to be prepared to be active in your investment if this is a sector that you want to make a home in, I suppose.
Correct.
But Peter, I think that kind of does it for me. Is there anything that you have on your mind that maybe we didn't touch on that you'd like to articulate a bit?
No, I think we covered a lot here. It's
No, perfect.
interesting times.
Well, no, thank you, Peter. Yeah, I think we're just nicely at the hour here, so I'll let you go. So in case you have meetings, and I appreciate your time, and thanks for coming on my show.
All right, thanks, Matt. I appreciate having me on.
Perfect. Have a good day.
You too.